Hey, how's it going, everybody? Well, this is so blinding. So if anyone's by the doors, wave people in because there's like stragglers. But welcome everybody to Refresh Miami. Thank you for coming. Give yourselves a round of applause for showing up and braving Miami traffic, which gets seemingly worse every single day. Soon this is just gonna be all virtual. Everyone's gonna be on their iPhones at home because it's too much of a pain to drive to. But yeah, so thanks everyone for coming, and we have a great event planned tonight. We have some experts on all aspects of fundraising for startups. So this summer we've been doing what we call the Summer Startup Series. So last month we had a design thinking event and a workshop, which many of you came to. And so that was all about you have an idea, improving the idea, validating the idea, refining the idea. And then this month is all about how do you fund the idea if you want to build it or grow it or get big, get to scale. And the next month is going to be how do you market and grow your startup. So we're going to be announcing in the next week our speaker for next month, but the date will be August 20th. It'll be right here. It'll be our last event here at the museum, and which we're super grateful for the museum's hosting us. So let's give the museum a big round of applause. The great folks at the Patricia and Philip Frost Museum of Science have been so awesome hosting us this summer, but unfortunately they're closing their doors in September, so we can't be here. But there'll be a new fancy schmancy, beautiful museum built in the next year. I don't know when exactly it'll open, but it'll be sooner or later, and there'll be sharks, so that's cool. And a planetarium. So maybe next year at this time we'll be in the planetarium on Biscayne Boulevard. Who knows? We'll see. So other great news. So on Tuesday we have a fintech meetup that we're hosting with Citibank. So Citi Fintech meetup. It's going to be at Lincoln WeWork in Lincoln Road, which just opened. So that's at 350 Lincoln Road on the second floor. We'll have beer and pizza and sodas and all that great stuff. And we have the CTO from Open English and the head of BizDev for Latin America for Airbnb talking about how do you do e-commerce abroad. So doing e-commerce in the United States is easy because you just turn on Stripe or PayPal, and all of a sudden you're taking credit cards and you're shipping off stuff using Ship, and pretty simple. So the whole point of this, though, is how do you go beyond the U.S. and Europe borders and sell to the other, 5 billion people on this planet? What? Yeah, it's a free event. There's 20 tickets left, so it's first come, first serve. So the link is on the Refresh Miami homepage. But so as I do this every month, so how many of you is this your first time coming to Refresh? Raise your hands. Awesome. So those of you who've never been here before, turn to the person next to you who didn't raise their hands and introduce yourselves. Because now you're part of an exclusive club of 9,000 people, and you're part of changing the future of Miami. All right, that's enough of introducing. So another thing I wanted to talk to you guys about was the topic, refreshing towers, the topic towers we introduced today. How many of you guys had a chance to talk to one of the experts at the topic towers? Yes? Did you guys like that experiment, that idea? Should we do this again? Yeah? So part of the point of doing that this month was we've been evaluating what works, what doesn't work, what kind of value do we need to provide to you guys? Because you guys do all this hard work of getting over here and contributing to the community and helping each other, but we wanted to figure out how do we make these connections and these interactions more valuable. And so this was our beta, so to speak, of how do we make this better. And a lot of people on the Refresh team helped ideate and think of different ways we could do this without making it too complicated or without making our lives too complicated to facilitate this. So I'm glad you guys like that. And so we'll be refining this idea and working on ways to improve it so that every connection you make in a Refresh is more valuable, and every interaction can provide more value to you guys and to your businesses and to your startups and your help you build your ideas and stuff like that. So since you guys all everyone applauds or clapped, we'll probably be doing it again next month. So I guess that's the last of my announcements, other than let's thank again all the sponsors who helped put this together. Ship, who didn't get a t-shirt? Did everyone get a t-shirt? So you should all talk to Alex and his team, who I don't know if they're still here, but they'll be there at the next one probably. There's only a few t-shirts left, but Ship has been graciously donating these t-shirts for us, and they'll mail them to your house, which is awesome. All you have to do is try the app. And then, so that's pretty much it. So without further ado, I want to bring up on stage Peter, who's going to be moderating. Peter's also responsible for putting this all together today. So let's give Peter a round of applause.
Thank you. So we're going to welcome the panelists one at a time. So first up, you have something else?
One last announcement. So for all of you who got the email newsletter, please fill out the survey that we're doing in partnership with the DDA. We're trying to figure out what it is that you guys need and help shape the future of Miami. There'll be a link on the Refresh homepage soon, but if you get the emails, it'll be in the next email too. So thanks.
Cool. So thank you again to all the people who manned the knowledge booths. They weren't exactly our speakers. They just were experts in the space, except for Stanley, who was also one of our speakers. First up, we've got Ed Boland, and he is principal at Scout Ventures, which is focused on emerging technologies enabling startups at South Florida and Latin America. Prior to joining, empowers, yeah, okay. So next up, we've got Stone Lee. Stone Lee is the co-founder of Urban.us, and he has a venture fund focused on startups helping improve urban living. Thank you. Followed by Brad Liff. Brad is the founder and CEO of Fitty Room Social. Prior to his role at Fitty Room Social, he worked at HIG Capital and private equity for over 5 years, managing $15 billion under management. Not personally, but yeah. Okay. And then last but not least, we have Herwig. Sorry, see, I told you, butcher his last name. Herwig, who is founder and CEO of Accredify, a crowdfunding, compliance, and accreditation company. Thank you. Cool. So, can you all make sure mics work?
Test. Testing.
Cool. All right. So, I guess before we get started, let's put some groundwork in this. So, some terms we hear a lot: seed, early stage, growth, pre-IPO, and IPO. These are all just stages of a company, but what do they really mean? What do they mean to you guys as people who invest and work in those spaces? Anybody can answer.
Are we doing round robin?
You know what? First to talk, and then you can also add on.
Okay, first to talk. Got it.
Got it.
Okay. The stages are really about it's not about the size of the investment per se, but really the stage of the business. I would consider a seed level company to be something that is more than an idea, but less than a business. And so you have an idea, you've built a prototype, you've built something, but you're not quite at the point of a sustainable business model. And at that point, you would go out and raise seed funding. The next level, the early stage equity financings, might be you now have some form of validation, but your business is not quite at sustainable levels for the future. And so now you go get that early stage funding for your business. And then beyond that, everything else beyond that, whether it's Series B, C, whatever you want to call it, to pre-IPO and post-IPO, really ought to be for growth initiatives of various size.
Yeah, the way we look at it is kind of a continuum where you start with friends and family, your very first capital, and some of that is your own capital, and it should be your own capital. If you don't have your own capital in your company, that's not sending the right message. So you start off with friends and family, and maybe that's $50,000 to $75,000 you put in. Then you move to angels, which are investors who invest in early stage companies, private investments directly. Angel rounds can go up to $500,000. Then seed rounds, which is where Scout participates in, and the seed and angel areas overlap. So we co-invest along with angels, and that you could be raising anywhere from $500,000 to $1 million, $1.2 million, and then you go into your Series A where you're looking for $3 to $5 million, and then you kind of get into the alphabet soup of venture capital, eventually into your liquidity event, which could be a acquisition or an IPO or a failure, in which case not a liquidity event, but that's how the companies end up.
We tend to look at it in 3 stages, centered around a period of time we call the Valley of Death. And the Valley of Death is after the idea stage. It's where good ideas and bad ideas go to die. But if you happen to have a good idea, which is actually a lot less than people believe, but if you do happen to have a good idea, and you have a great team, and you've actually been able to build a product around that idea, you eventually get out of the Valley of Death, and then your trajectory is varied. You could end up getting to a sort of a semi degree of success / failure, which is you build a sustainable business that continues to produce revenue, maybe turns a profit. Not necessarily what venture capitalists are looking for. They are generally looking for you to eventually get acquired or to go public. And then obviously the fourth outcome of somebody really screwing up even after you've gotten out of the Valley of Death, and your company could still die.
So you said something.
So at any point.
So Ed, you said something interesting, that you said you team up, you follow on, you partner up. And so there's a common misconception that you go to one angel, one fund, and then you're done, right? In many cases, that's not the case, or is it?
No, it's actually, especially in the early stage, that's rarely the case. And in Scout's case, we're a venture capital fund. So unlike angels, we're not investing our own money. We're investing other people's money, our LPs, limited partners. So we're that much more thoughtful about how we do it. It's like, if I'm watching my son, he gets hurt, that's no big deal. If I'm watching my neighbor's son and the neighbor's son gets hurt, that's a lot worse for me, to have someone else's son, get hurt on my watch. So oftentimes our LPs will co-invest with us. So we might put in X amount, but we know we have people who like deals, and they might say, all right, well, I'll put in 50 to 100 on top of that deal. And if we have something interesting in the seed stage, it's very cooperative. So we'll show it to other investors. We'll call Melissa at Krillian, or we'll call Mark Kingdon, or we'll talk to Nico at AGP and say, like, have you guys looked at this deal? As a company gets bigger and they get more successful, more traction, you see at later stage VCs, it gets more competitive, and they want to keep other VCs out and take down a whole round themselves. But in that early stage, there's a lot of cooperation between angels and early stage funds.
Yeah, I want to actually add on to that is in the early stage, especially when you need to look for somebody, you want to call what they call a lead angel or a champion, somebody that wants to sort of take that first bet on you and bring all the other investors in, as you've been pointing out, they all work together. But it's really important you find that one investor that believes in you and is ready to really introduce your company to everybody else.
Cool. So lead investor. Obviously, that's generally somebody, like you said, champions it. Primarily, probably puts a larger chunk of the investment in to get it started. So, at what stage do you guys normally? So, representing your individual sections, what stage does your investment group typically come in at? Like you said, seed, and there's others.
So we invest before and during the Valley of Death. What we're looking for is the right team, and following that, at least the impression that they're building the right product, or that they've already built the right product and found a few initial customers, users, etc. And we're funding them through that process of surviving and getting out of the Valley of Death. Paralleling with actual funding stages, that generally means we're investing at the pre-seed and seed stage, and we're co-investing at those stages often, and we're also co-investing at the Series A and that's generally where we drop off from then on.
Okay, you mentioned good team. Can somebody elaborate on what you think a good team, or rather, what do you look for when you're looking to invest in a company, the team, the traction? So what does that mean? What's a good stage? Specifically for early stage, because that's a lot of people here.
Well, I think, every VC and every investor should have a process. And at Scout, we have guidelines to what we look for. And a proprietary technology. We like just some of the things we just happen to like. We like veteran entrepreneurs. We like founding teams that have a tech and non-tech component. That kind of the technology and the sales part. We like companies that have a clear path to revenue or are thoughtful about revenue. So all that is within our process, and within that you really zero in on team and culture, because a firm like Scout, across 2 funds, we're invested in over 50 companies, and we can't micromanage 50 companies. So where we add value is through process and business development, but we need the entrepreneur and the team to be able to execute. So we need to have the confidence that they're going to be able to do that. That's why the team is so important, because we're really making the bet on them.
So we look at team on 3, at least I do personally, but I think my co-founder and managing partner, Sean Abramson, would agree. The 3 main things are that the team is the right fit for what they're proposing to build, meaning that they actually can build it. And within that team, they can also access the customers that that product is going to be for. So team product fit is one way to put it. The second one is a little bit tricky because it's more of a soft skill. Having been a founder myself and primarily spent the last decade building companies, I like to think that I have a pretty good bullshit meter, and therefore can talk to an entrepreneur and get an assessment of whether the entrepreneur is either just really arrogant or they really have something. And normally the people who really have something don't have to be arrogant. They just have a confidence to them. They know what they're talking about. Their reputation precedes them or can be verified. And those are the sorts of things that tells you that this person is going to be able to work with people, going to be able to attract the talent and capital and investors that they're going to need to help them succeed. And then finally, and just or maybe even more importantly, is do they have the resume to back that they have the potential to build a great company. And that resume can mean a lot of things. It could mean that they went to an awesome school. Doesn't necessarily have to be that. It could mean that they came from awesome companies. That shows that they've been in a very competitive environment and have succeeded before. It could be that they've built other companies before and have succeeded, or have failed, but have learned and proven that they've learned a lot of lessons from it. So I'm generally gauging, those 3 things. Is it the right team? Is this person a stellar person? And do they have some sort of background, past or current truths about themselves that show that they are on the trajectory for success?
Brad, you're an entrepreneur in resident at Rocker Labs, and dozens of companies go through the doors there and pitch to try to get accepted into Rocker Labs. Now, I'm pretty familiar with this, but I know that it happens all the time. Founders tend to want to just do like buzzword soup. And so, where's the balance between like using buzzwords and attempting to sound like you know what you're talking about and actually understanding what you're talking about?
Well, it's typically a good idea not to bullshit with someone you're trying to get money from.
But it happens all the time, though.
It does happen all the time, but as to only just will tell you, when you're talking to someone with experience, they tend to have pretty good bullshit detectors. And so, at some point in the process, you're going to get discovered if you're just bullshitting your way through. People, despite what Ed said, people value their own money a lot, and they're not just going to cut you a check if, by using a bunch of buzzwords and not really bringing something to the table beyond that. And so you may get yourself through the first meeting, but I think there's that Mike Tyson saying, right? Everyone has a plan until you get punched in the face. Well, you can have your plan, but you're eventually going to get punched in the face, and you're going to get found out.
Cool.
Yeah, and you see a lot of the complications spill over into crowdfunding too, because the whole difference is you're really viewing everything through the web. You're not, probably you don't know that individual or having the opportunity to meet with them about their ideas, so you're really looking at the team to see if they can follow through, to see what kind of experience they have, and really you need some kind of growth or traction to prove to people that this idea has potential, because you just have to try that much harder and do that much more work in trying to convince someone to invest in you over the web as opposed to just as they all do.
That's a good point. How does somebody who wants to do crowdfunding, because crowdfunding actually is a great opportunity, right? Because it sort of democratizes fundraising, especially with this, Reg A plus. So, like, how does somebody get themselves ready to pitch to anonymized investors?
Yeah, and so crowdfunding is it's a new technology. It's still really much so in its infancy, and we're seeing where even you have family offices and VCs taking advantage of these technologies just because it simply automates the whole process. But then you lose a lot of that value into being able to verify with people. And so actually, as of 2013, entrepreneurs weren't even allowed to tell people they were raising money for their business. They actually had to arrange these meetings with investors, fly to different cities, and meet with them in backdoor rooms to have these deals happen. But as of 2013, the SEC, thanks to something called through the Jobs Act, has allowed for entrepreneurs to generally solicit, aka tell everybody that they can raise money for their business, hence the rise of crowdfunding on the internet, except one problem being that you now actually have to verify investors, which is more friction, and you see what Peter was mentioning is actually an even newer technology, something as of last month in June, the SEC passed Title IV, which is called Regulation A+. It's the first time ever that any American is going to be able to allow to invest in a private equity investment. And that's actually going to be probably steered towards more later stage companies because they have to do a lot of SEC filing, and they can raise actually up to $50 million from both non-accredited and accredited investors. So you're definitely going to want that.
So we're talking about the amount of money raised, and we spoke earlier, friends and family, we talked about seed and early stage. Can somebody just sort of generalize sort of the amounts at the different stages so that people get an idea of like they're going to ask for $1 million at a seed round? That doesn't make sense. So let's set some expectations.
Sure. I mean, I think the numbers really can be that high in a seed round.
Sure.
They can even be higher. I think Magic Leap could realistically be called a seed investment at $500 million.
But he came from Mako and it had all that stuff, and so
yeah, exactly. I think
serial entrepreneur does add value.
Exactly, and I think to me the distinction is where is the business in its own cycle as opposed to the size of the funding it needs. And so if you are before product market fit, or if you're before true market validation, then regardless of the amount of capital you need, I think you could feasibly call yourself a seed round. After that point, I think it really depends where in the valley of death you're lying. And if you've gotten to the point where you have validated part of your business model, but you're not at a level of sustainability where you're self-funding or the cash flows coming off your business are enough to support your business, to me, in my mind, that is where you're at a Series A type investment where you've validated quite a few things, but you still require outside capital to get to the next stages. And then everything, to me, beyond that, again, regardless of size, is growth capital, whether you call it Series B, C, D, or growth private equity, or whatever it might be. At that point, you're just taking growth investments.
Okay. So locally, we have a bunch of angel groups, AGP, New World Angels, and a handful of others. But within angel investors, what is an angel investor? Because can somebody just say they're an angel investor and then start giving away money?
Technically,
I hope so. They do here.
Well, I mean, yeah. So to Ed's point, a lot of people do, but it's not technically true. To the point earlier about being accredited, that's a pretty critical factor. As you, at least traditionally, as you raise later stage funds or even eventually decide to maybe go public via the IPO, the initial public offering process, part of that process is becoming compliant in all of the shares that you've ever distributed. So compliance meaning that you have not sold equity in your private company to anyone who is not accredited. So giving a piece of your company away to someone who says that they're an angel investor and is willing to give you a check, but you haven't verified if they're actually accredited, can bite you in the butt in your IPO process, in that you then have to go and get that corrected, file a bunch of paperwork to correct that, and it can kill your IPO process. So that's one challenge.
And just so people are clear, the accreditation is a net worth of, is it 5 or 1 million, and then or an annual 2 million in annual income of 200,000. So that's an accredited investor. So if you're getting money from an angel, you should make sure they're accredited, but you should also be looking for what kind of value are they going to be adding outside their capital. I mean, because at the early stage, you really want someone who can add some value beyond the capital that they bring. At every stage, you would like that, but I think at the early stage, it's crucial. So if you find an angel who has a certain subject matter expertise, or happens to invest in a certain industry like mobile or gaming or what have you, those are the types of angels you want to seek out for your initial seeding, because those are the ones who can be able to help you the most. The ones who add capital but not much strategic value also tend to be the ones who kind of try to tell you how to run your business. I've seen those relationships end very poorly.
And to one more point about angels, and I'm going to offend a few people, to borrow a little bit from Christian mythology, what do you think, what's a fallen angel called? A devil, right? So there exists the type of angel who once was helpful and once was able to write checks, but no longer is able to, but will still take up your time and resources, learning about your company, presenting themselves as being able to invest, but then eventually never really providing that value that they originally presented. So, and then the same, a false angel, which is somebody who never really could invest in the first place. So, the warning is to you, prospective entrepreneur raising money from angels, make sure that you're not the first or the last check that this angel is trying to write, because it will be close to impossible for you to actually get that check from them. That comes from actually asking for references and seeing where else they've invested and getting an idea of what their plan is as far as their long-term strategy in investing. And if you have something that's worth investing in, just like in job hunting, just like in anything, you have a right to interview the person who you're asking for something from. And it's worth it to ask those hard questions, because the one thing that you don't have an infinite supply of is time. And every minute that you spent doing anything other than building your company is detrimental to the future of your company. Raising capital is not the fun part of building a company. It's not the part that you should be looking forward to. It's the part that you should be looking past and trying to get through as fast as possible. And part of that, getting through that process fast, is make sure you pre-qualify the people that you're spending your time with.
I think that really speaks to also personal relationships in that process. There's a big difference between angels that are strangers to you and angels that are introduced to you through your own personal network, who care about you, who know you, who you've known for many years, who you know are going to stick around, versus finding someone on LinkedIn and clicking them and hoping that they're going to give you a check. Because those are the scenarios where even if somehow you manage to succeed in that route, the likelihood of it ultimately flaming out is pretty high. And I think in that process, developing and maintaining those personal relationships is oftentimes the most critical point in getting an early stage company off the ground.
Cool. We're going to stay at angels for a couple more points, just because it's a big part of early stage funding. So we all know what an angel is now. Explain angel groups or syndicates. Like, syndicates are relatively new, so let's talk about that.
I'll tackle this one. Well, especially since crowdfunding is really a really super powerful tool for angels who are trying to find those deals, or maybe looking for the good deals in other cities that they can't verify. And what he mentioned about syndicates is basically investing in another angel, or investing alongside a group of angels that all make an investment, or somebody, for example, who's a famous angel investor. You would put money into them and take a return on whatever they make from from their investments. And so that's a really easy way to mitigate your risk, or if you don't actually have the time, because it takes a lot of time to be an angel investor and to follow up with companies and verify and do the due diligence. And crowdfunding, as I've mentioned earlier, it makes it way more complicated to try and verify that and do your due diligence. And so angel groups are a great way for someone to easily join who's interested in private equity and is eligible, and to sort of get deals sourced to them, whether it be through an offline angel group or online through a crowdfunding platform.
Sure. I think in my role as a founder, I've actually been pretty skeptical of angel groups overall. I mentioned about having personal relationships with your original investors or your early stage investors, and through angel networks, it's very difficult to maintain those personal relationships because the nature of a network is that it's dispersed, and you can't really generate those relationships. And you often hear that investor relationships are like real personal relationships, like with your girlfriends or wives. And I know, like, I met my wife through mutual friends, and we were introduced that way. And I think angel networks are more like the equivalent of J-date. It's like you hear the stories of them occasionally ending up in marriage, but mostly it's just a bunch of people trying to get laid. And that's I think the difference between having true personal relationships and then relying on a broader distributed network.
So the term I think that we keep bouncing around here, or rather we haven't said, but it's the smart money and dumb money. We keep talking about like relationships and getting to know people. So I think the term, in case they want to Google it, is smart money or dumb money. Well, obviously you guys already talked about it, but effectively, smart money is somebody who gives you money, and additional to that is resources, network, and/or abilities, and then dumb money is just here's some money, but they're pretty much that's it.
Yeah, I think the dangerous part is not so much dumb versus smart; it's the in between. When you find truly smart money who can really add value to your business, like that's really what you want. And then there's like I think I would refer to this as being the dumb money, like the really passive money that gives you a check but doesn't really bother you or jump into your business. It's the folks who are in between who cause the problems. They're the ones who are writing a check but not really being so helpful or supportive and really causing issues. And so I'm not sure if there's a name for that in-between person, but that's where I see the most trouble.
I like to think of it as not necessarily smart versus dumb. To your point, Brad, it's not. It's more harmful versus helpful money, and harmful is anyone who takes up non-useful use of your time. And that can be someone who thinks that they're being helpful, that they think they're smart, and they think that they can give you advice, or that they need to sit in your office every day or every other day of the week to tell you how to run your business. But then on the other side, helpful can be somebody who really can help you, who really can offer connections, recommendations, advice, etc. But it's also, to Brad's point, it could be someone who just gives you the check very quickly and gets out of your way. So you need to decide what kind of helpful is this person, or is this person just going to be harmful?
Which, by the way, which is easier said than done, because if you're burning through cash and you're looking at, you've got a 6-week runway, and you've got someone who's willing to put money in that's going to get you another 6 months, but it might be a problem, but that's Brad, you're an entrepreneur. I mean, those are difficult decisions. So it's not always as easy as like, oh, this guy's going to be a problem, I'm just going to walk away. I mean, there are times where you might need that capital to get to your next benchmark, to get to that extension, to get to your next round. So not always as easy as it sounds, as we're making it sound like an easy decision.
Right. Absolutely. So one thing I want to touch upon is obviously the types of investment vehicles that are given to accredited investors. So things like convertible notes, safe deals, and then just pure equity deals. So what are the advantages, disadvantages of these types of investment vehicles, and then sort of both to the entrepreneur as well as to the investor? So we'll start off, actually, let's take them one at a time. Let's go with a convertible note, and then we'll move on. So.
Sure. The convertible note is just the gold standard that everyone kind of understands and has used for a million years. They come in there's many different terms and many different types, but they're like the workhorse of funding an early stage company. In yeah, I'm sure we'll get to this as we talk to safes, but what people have been trying to do is make it simpler and make the process more transparent, and that's how people have now been moving away from convertible notes into things like safes. The risks of a convertible note from a founder standpoint is that it's debt, and it comes with all the issues of debt, which are maturity dates, potential covenants, there's an interest component. If something goes wrong, that money gets paid back first. All the things that come with debt, just like as would come in your personal life, comes if you do a convertible note. And so some of these instruments like safes and straight equity investments are meant to alleviate that, but there's no free lunch, right? They come with risks as well. And so these are all great tools, and to me, the right one is the one that works best for you and your investors.
Yeah, and that's something you have to be thoughtful about as you structure your financing. Just to kind of the way we look at it is we generally prefer at Scout. We generally prefer straight equity to keep things as simple as possible. We do participate in convertibles, but there's kind of a conception where if you do a convertible note, you can kind of kick the valuation question down the line, and that's why people like them. But when we look at them, when an entrepreneur, when a business sets a cap, we're getting the messaging that that's the valuation that they really think of. So like we see a convertible note with the cap, essentially we're translating that's the valuation. So we look at it like we prefer simple, straight up equity deals because we know in subsequent financing, the cleaner your cap table is, the easier the subsequent financings are, and that's when things get very confusing, and you get lost in the details of these convertible notes and the stuff you put on before, and then the new investors and stuff. So that's when you get the lawyers involved, and so every time we've had kind of long financing issues, they've come out of convertible notes actually. But not saying it's not the right tool, but just saying that's what we've seen, and that's kind of how we look at them.
So let's zoom in on the convertible note because it's the gold standard. All right, so you said interest rate, like it's a loan. A lot of times people assume that they're just going to pay back the investor the interest rate while they borrow the money at some rate, sort of like a credit card, right? You just pay the premium, but that's not the case, right?
That's right. So a convertible note, as the word implies, it converts. And the manner in which it converts can vary from deal to deal, but the assumption from the investor, and certainly the assumption from the entrepreneur, ought to be that at some point that note is going to convert into equity, and that person who was a lender is now a partner in an equity investment. And so you need to treat them as both, right? You need to treat them as someone who lent you money, and they deserve the protections of someone who has lent you money, such as you agree not to do any sort of crazy things with their capital that were not agreed upon in advance. You agree to provide them information on a timely basis. All the things that you would have to do to the extent you actually borrowed money, you have to do with your convertible note holder. The difference is that in an early stage company, as you grow, there's that expectation that when you hit either the conversion, the cap, or a certain valuation, or a certain liquidity event, that note is going to transition into a different type of security. But the long and short of it is, regardless of the instrument you use, that early stage investor, they're your partner from day one moving forward into the future. And so while there are pros and cons, there are things that make them more and less complex, and they can vary from deal to deal. Not every convertible note is the same, not every safe is the same. Within reason, they're structured to get you to the same place, which is put the company in the best position possible to succeed. And if for your company, if that means a convertible note, great. If it means it's a safe, that's great too. It doesn't really matter as long as the company is positioned for success.
So I'll go.
I think just to sort of bring it to more practical terms, I think there may be a few of you that don't even know what convertible note is, maybe.
Sorry.
So it's a form of a loan where instead of immediately being something that you have to pay back every month like a traditional loan, there is a trigger that's set. There are two triggers. One is time, meaning after a certain amount of time, it becomes a normal loan, a traditional loan with a certain amount of interest rate. And in some cases, to Brad's point, it could be written that it's just a balloon loan where it's just immediately due after a certain point. The other trigger, and that's the trigger that we don't want to happen, that nobody wants to happen. The other trigger that everyone wants to happen is that you actually raise a price round, an equity round, and that note then converts into part of that priced round with certain limits, a floor of the value that note would convert to, meaning that by building a discount into whatever conversion happens, that investor can guarantee something like 20% return on their original loan to you, because whatever they gave you, they're going to get a 20% discount on whatever the round ends up being. It could be more if the round ends up being exceptionally high valuation. And the other thing that a convertible note allows you to do is to move faster, because you don't have to pick a price or figure out what your company is worth to do a convertible note. You're basically just saying, here's the money, here's what I want to get back, at least 20% on it. If you raise more money, if it's worth more than that, great. If you don't raise money, you owe me this much money plus 20% plus interest, etc.
So I'm going to let eventually Herwig go over some like nightmare scenario and convertible notes that he's seen. But before we get into that, the cap. We keep talking about a cap. What does a cap mean in a convertible note?
Sure. So the cap is the maximum valuation at which the investor can convert into equity. And so the best way to really think about it is probably just to use an example. If I put $1 million into your company and we agree that the cap is $5 million, then regardless of what your next valuation is, whether it's $5 million, $8 million, $12 million, or $100 million, I am going to convert as though the valuation was $5 million.
Big win for the investor.
What's that?
Big win for the investor if you're
That would be a
worth
big
more.
win for the investor if it's a $100 million
Plus
valuation.
the discount.
Now the discount basically says if you don't achieve the cap, so in that scenario, if the valuation was only $3 million or $4 million, so you have not reached the cap, as the investor, I'm still going to convert at a price lower than the next guy based on that discount. So the cap says no matter how well you do, I'm only going to give up upside to a certain point, and the discount says if you do worse than expected, I'm still going to get a little bit extra pound of flesh compared to the next person. So it's a way to kind of bracket the outcomes, right? On the upside and the downside, the convertible note investor knows within reason where he's going to fall out.
Not necessarily within reason. People don't read the terms.
Exactly. Worst case, you find yourself having to pay somebody a lot of money, or second worst case, you end up having to give away too much equity in your company, where you find that you don't have enough equity to then raise or give away to find more employees or to raise more money, and that I've seen that happen as well. And actually, Brad's also mentioned something called the safe note, also a pretty new form where it's set agreement for future equity, where it takes out the loan aspect of the convertible note, but still relies on those triggers to make an execution happen.
So what's a bad? I mean, obviously, there's many ways to structure a bad deal. I've seen plenty. Now let's talk about just an overall example, what to watch out for when you're doing. Because again, convertible notes are the standard. So what to watch out for?
Yeah, I think for converts, it's first of all the maturity. You as a founder, you need to give yourself as long a runway as possible. And the last thing you want is to say, oh, I only gave myself 18 months. Yep. And then the maturity comes up and you're in the middle of closing 10 customers and your investor calls and says, oh, that $1 million I lent you 18 months ago, you owe that to me now.
Well, moreover, it's the company's not set. You haven't raised anything, so you didn't trigger. So you go to a company that takes the valuation, and your company's only worth 1.2 million. So now they own 90% of your company.
Yes, that would also be a pretty poor outcome, I would say.
We've seen investors call notes and basically bankrupt a company before. It's happened, and so you obviously have to be very weary about maturities and just kind of a lot of inexperienced investors will put some like weird funky stuff on like covenants on a note. And when we come in and see that stuff, we have to kind of go through and untangle that. Because remember, anything you put, any sort of covenant, any sort of deal you put in one financing round is going to have effect on your next one. Because anyone coming in after is going to look at what the terms were before and where they fall in line. And so, if you have investors trying to put kind of strange covenants on your notes and stuff. That's something to be very, very cautious of.
You can mess up a deal. In other words, if your first round puts you in a position where you can never raise again.
Yeah, you're done, basically.
Yeah. I would just go back to what I said before, which is your early stage financing, both in its form, in the person who provides it, everything that goes into that first or second round of financing should be done to make sure that the company is in the best position possible. Not the investor in the best position possible, not the founder in the best position possible, but the company. And so anytime you see a term in there that can blow up the company, you got to avoid that. So things like early maturity dates, covenants that are technical in nature that are very easy to violate, that can result in an investor blowing up your company for no good reason. Anything that gets in the way of the company's success should just be withdrawn. And the safe note really goes to the heart of that. Its sole purpose is to withdraw any possible landmine that could possibly exist in the convertible note process.
So
that is literally why
ideally
it exists.
you want a safe note if you can, but that's just if they offer
Yeah,
it.
the safe note isn't like a magic bullet. It comes with its own issues too. But relative to a convertible note, it doesn't have those, I don't want to say hidden because they're not hidden. They're in a document, but they don't have those potential landmines to blow up a company the way a convertible note does. But there's other issues about a safe, which is from an investor standpoint, you're kind of investing into a black hole. And there's many things from an investor standpoint that can go wrong, and it's such a new instrument that people aren't really sure what happens if things go wrong in a safe investment, right? The name safe sounds great, but that doesn't mean if things go bad that it's actually safe. And so people feel comfortable with a convertible note because it's, like I said, the workhorse or the gold standard of investing. The safe is designed to address some of the issues that have come up in convertible notes. And the right answer, again, is whatever works for your company.
Okay, so we've covered a lot of things about angels. Let's move on to venture capital, which is a natural progression here. Well, unless you're super profitable and never need to raise money again. But then again, there's always opportunities for growth, so you never know. Within venture capital, there are tons of venture capital firms who invest in different verticals. What makes a good VC partner?
Well, I'm a little biased, but I like to think that knowing that a firm has some sort of focus not only helps you find them, because you know which ones that would be more helpful to you, but it also means that they've galvanized their efforts to be helpful around that focus. So at Urban Us, we've spent the last 2 years building out what is now 800 people worldwide who are paying attention to the startups that we're working with and the research that we're doing around the sector. And so we have a pretty large pool of people that we can refer our founders to at times when they need help from, whether it's to talk to more customers or to talk to investors or partners, et cetera. So I think being specialized lends itself to some degree. And then the alternate to that is if you are looking at a generalist firm, looking at their existing portfolio. So the other way that a VC firm can be helpful to you is connecting you to the founders of the other companies that they've invested in. So they essentially have built their own small but powerful network, which is why firms like Sequoia and even Y Combinator now becoming a firm in its own right have so much potency because they've built such a great alumni network. But again, it's really just a question of helpfulness versus harmful. And, a generalist that is excited about you and willing to write a check really quickly is still a good firm to partner with, in my opinion.
Yeah, and we're at Scout, we're generalists. I mean, our focus is on companies that leverage technology, and social connectivity and viral distribution, and that has a very broad range of applications. And where we add value is as a firm that's invested in over 50 companies. Our founder, Brad Harrison, has been doing deals for almost 20 years, and he'll always tell you the best way, he gives the example down here in Miami where real estate's so popular, is the best way not to get screwed in a real estate deal is to get screwed in a real estate deal, because you'll never let that happen again. Well, Brad will tell you he's been screwed in every way possible in venture deals, so he knows exactly what he's looking out for. what companies need to be doing to be taken seriously by a Series A firm. What do their contracts need to be looking at? What their legal needs? What's their cap table? All those things are the value a firm like Scout can provide. And then also leveraging our proprietary network to help on the business development side. I mean, through our networks, Brad's network, through his time in the military, AOL, his time at AOL, his time at MIT, he's developed an incredible network of people where he can pick up the phone and call the VP of development at Sony because there's an interesting company that they should be looking at and maybe doing business with. So I think, those are the types of value adds that a good VC can bring to a company.
Cool. I don't actually have another question for venture capital, but would you guys have anything you'd like to add towards the VC that we haven't already discussed?
Yeah, I would just say I would look at VCs the same way as angel investors, which is you have to find, through your personal network, the personal relationships, to find people who can add value to your business and add value to your life. Right?
Oh, actually, I got a good question.
I think the only difference between angels and VCs is VCs are way more methodical about it. They generally have sort of a criteria they're looking for. They, I like Ben Horowitz, a partner at a big VC firm in California, does a great example of it. It's like an onion, and they're always peeling away risk. Is the team good? Is the idea good? Is it feasible? Is their cap table clean? That's sort of, I think, the big difference a lot too sometimes.
I think it's worth noting that difference is pretty significant, and that difference stems from the other major difference between angels and VCs is in that venture capitalists, as Ed pointed out earlier, are investing, for the most part, other people's money, limited partners. And when they originally get that money from those limited partners, it's based on a plan. And that plan is varied, but normally these are the types of things we're going to be investing in, these are the regions that we're going to be investing in, these are the types of exits that we think we're going to get that's going to eventually return as a fund, the type of returns that make it worth your while to invest your money, to park your money with me or with us for 5 to 10 years. And so it's much more difficult for a venture capitalist to deviate from that strategy. An angel is investing their own money. They can deviate. They can find a great idea that they know will never be an IPO or will never be acquired, but they really believe in what the founder is doing. They really want to be supportive, and they feel that the company could eventually at least become profitable. Whereas a venture capital firm needs to see that this firm, that this company that they're investing in, will eventually provide a large enough exit that it fits within the strategy of their portfolio. For a lot of venture capital firms, that means that one investment has to be exciting enough that even if all of their other investments failed, this one investment could make the portfolio a success, or one or two. So the point that I really want to get to here is that before idolizing venture capital as a source of funding, you really need to analyze and assess whether or not you're building a venture capital fundable company. Going after venture capital funding is a long, arduous process. It comes with the cost of giving away large chunks of your company. And in the end, you're really just going to burn away that essential time that we talked about before in an effort that could never bear any fruit because you don't have a venture capital fundable company. So deciding whether your company can grow to the size of providing 100 or 100 million, multiple hundreds of million dollars exit or IPO, deciding if that's ever going to happen in 5 to 10 years even, is the first question you really need to answer to yourself before you go down the path of pursuing venture capital.
You brought up a good point. In terms of, well, you've brought up a lot of good points. But in terms of, wow, I'm blanking out right now. Sorry. Yeah. Oh, right. So in terms of like owning a little bit of something big, owning everything of something that doesn't have any value. So how much equity are we giving away at each of these stages? Like the founders tend to want to hold on to as much as possible, but the reality is, a lot of that has to go either for strategic hires, to raise capital. There's a million reasons, but understanding sort of like generalist rules, like what are we looking at? Like seed, angel, so on. Obviously, safe and so on don't set valuations, but there's after it converts, we know that it generally is around this range.
Yeah, I mean, I think there's rules of thumb, but there's certainly no hard and fast rules. I think in the early stages, you're probably looking at giving up 20 to 30% of your business. If there is a founding team, then Obviously, the team itself has split up the equity according to some hidden formula that recognizes how brilliant the CEO is and how less brilliant the CMO is or something. But I'm kidding. Each stage, you want to be giving up something like that percentage. And if you're the founder and you own all of the equity on day one, I think you'd be in a very happy place if at the end of the process you own somewhere between 10 and 30% of a very large organization. You'd be thrilled with that outcome. And how you get there, some of those rounds will probably take more and some of them will take less. But at the end of the process, if you ended up in that situation, I think you'd be pretty happy.
I think I'll disagree slightly in that I think there are no rules of thumb. You have plenty of examples of companies where the founder ends up with so little in the company that at an exit point, and even what some would call a respectable exit of a few $1 million, $100 million, or whatever, the founder still ends up with very little at the end. And then contrarily, Mark Zuckerberg retained, I believe, close to or over 50% of the company, even up to the point of the very, very later stage, pre-IPO stage of Facebook. So the meter that determines how much of your company you give up really comes down to when you're raising money. If you're raising money when you need to raise money, then you're going to end up giving up more equity than you probably would have wanted to, because you're in a position of weakness. You need to raise money, your company's going to fail. If you're raising money from a position of strength, which is that you don't need to raise money, but investors would benefit from being co-investors with you in that company, and you have the proof to show that you don't need to raise the money, then you're going to be able to retain a larger percentage of your company. You're going to command a higher valuation and so forth. And obviously, it's not a perfect formula of whether you're going to be able to do one or the other, but you want to get as close as possible to targeting when you raise money to be around the times when it's very clear that you don't necessarily need to raise money. You're already growing very healthily, and can therefore command much better valuations and can command better terms that allow you to retain more ownership of your company. But to Peter's original question, in the end, as long as you're structuring it in a way where you can outline an exit scenario, multiple exit scenarios where you still end up getting paid back for all the work that you've done, then there's nothing to be you could certainly be proud of retaining even 1% of a company that exits at a few $1 billion if you're able to take home, $100 million from that.
Cool. So, it varies. Now, Herwig, these are for you, but anyone can answer. Crowdfunding, it's a big thing, right? So we're all expecting it to be a big thing, but it still hasn't quite taken off where it needs to be. So tell us why, tell us how it came, and then what are we waiting for, and some recent developments.
Right, so I may have mentioned the Jobs Act, which is sort of what set this whole thing in motion. And the big ones that we've covered is Title II, which is the 2013, that allowed everybody to generally solicit, but it's still limited to accredited investors. And we talked about it earlier, there's about 8.6 million Americans that qualify under that definition. And only about 3% of them actually participate in private equity. So of the majority of them, don't even realize or don't even care for investing in this equity investments. But the big thing now is Title IV, which is going to allow everybody to invest. And there's another one that's called Title III, which is in between. That was skipped because it's even more ambitious. It's going to allow anybody in the world to also invest in U.S. private equity up to about $1 million. And so everyone's sort of waiting for those rules to kick in. But the reality is this process has never changed for over 80 years. And so this new technology and the internet being introduced is just leading to a lot slower of a growth than sort of everyone expected crowdfunding to be. But we still, to this year already, over $1 billion has been raised through equity investments through crowdfunding, which is... Go ahead.
I was going to say, and at Scout, we're very, one of our tenets is the shared economy, and we think crowdfunding is a part of that. And we are early investors in a company, Seed Invest, which is an online investing platform for...
There's someone here from Seed Invest.
Ken here?
Yeah.
Oh, okay.
You can talk to him. He's right over there.
So
he took your money.
Well, if you're a credit investor, you can go on Seed Invest and you can actually invest. But we think this is going to be a tremendous opportunity for companies. We think crowdfunding both in its kind of Kickstarter, Indiegogo formation, but also in the equity formation is going to be a huge shift in capital, almost along the lines of when online trading was introduced. So you'll have a class of people who will go online and put a few $1,000s in a portfolio of companies that they like, and you might be able to, if you're raising a seed round of $500,000, you might be able to top off the round with another 50 or 100 grand through an online platform, and we think that's how it's going to be. That's where we're moving towards, and we think it's going to be a great tool for entrepreneurs.
Yeah, we even see potentially in the future where a private equity exchange or a pre-IPO market of privately held securities exists and becomes actively traded as opposed to on the public market. And it's worth mentioning the distinction too that people hear crowdfunding, they generally think of Kickstarter, and that's actually how it all started, is rewards based, where you're giving in exchange for some money a gift, or actually it's really pre-sales, you're giving them the product or promising them the product ahead of time, and then you have this equity side where you're actually giving exchange securities or equity or a debt-based investment which is limited to accredited investors. So you have this really big confusion around crowdfunding, and I think that's eventually just going to mold together where you'll see combinations, or you'll see that it's very clearly the opportunity to invest versus just kind of back and put your money behind.
Talk about the Oculus Rift model, like what that would have been.
So Oculus Rift is a great example. I'm sure everybody's heard of it. If you haven't, it's sort of like the leading virtual reality company out there, and they raised their money on Kickstarter, a rewards-based platform. And they raised several $1 million and eventually sold a few years later to Facebook for over $2 billion. And so a lot of the backers on Kickstarter were slightly upset. They didn't get a piece of that money. They felt like they helped build that company. That company didn't exist before they managed to raise their money and build their product through Kickstarter. So you saw this uproar of people complaining that they didn't get a piece of the action and sort of put equity crowdfunding into the mainstream.
What was like the $500 for an Oculus Rift would have been what?
Like $10,000 or something like that.
Yeah, like a year later.
But they got a free T-shirt, right?
Oh, that's
They
right,
got a
free T-shirt.
That's true.
So what are they complaining about?
So clearly crowdfunding it's in its infancy because of the regulation to accredited investors, but there's breakage right now with Title IV, Reg A+, you might hear that, Regulation A+, where anybody can invest. It's just a little harder for the company to get listed as that. And Title III, where anybody can invest online up to a percentage of their net worth. So it'll stop people from accidentally putting their life savings into a startup that doesn't go anywhere. But yeah.
I think it's worth noting as well that one of the other points of contention in early stage funding in private equity is what's something called information rights. In the earlier stages of a company, you don't necessarily buy rights in most of the terms. Not necessarily, unless you explicitly put it in. You're not buying rights to be able to bug the founder for legally deliverable progress reports and updates, et cetera, et cetera. For the most part, if you have a good relationship with the founders, they give you that sort of thing anyway when you ask, or they regularly update their investors. At least the good founders do. Now, the challenge that's going to arise, it's already arising with some larger what's called party rounds, where there's just a bunch of people in a seed stage round, is that a lot of people now feel entitled to knowing what the founder and what the team is up to. And that becomes a growing burden on that team. So one of the challenges that, as we start looking at crowdfunding as a viable equity option, is going to be picking a platform that allows you to manage the exponential number of relationships that you then create based on those crowdfunding rounds.
One of the problems in crowdfunding right now is just the way it's structured, where it's fee-based versus percentage-based for the crowdfunding portal. It doesn't behoove the crowdfunding portal to actually provide those type of resources because it's a one and done and it's diminishing returns otherwise. And so I think what we'll start seeing is like companies starting to provide these types of services in systems to to provide this type of information as well as other things.
It's a big problem because we've talked about this very problem for just regular investing too, is dumb money versus smart money, right? You don't want people calling you and someone says, I invested online $2,000, I should know every month how you're doing and your growth rate. You can understand how that might not be manageable. So it's really thinking about it, and a lot of companies actually do it, or platforms I should say, where it's actually represented as one person on the cap table, and it's just the platform. It's not everybody that invested specifically, and so it does become very important that where you're getting information is it coming directly from the entrepreneurs, and that you understand that that's going to be a lot of work if you go down that route.
Yeah, I think the advent and the maturity of a secondary market for these issuances will create the incentives to then provide the information.
So as it stands right now, a secondary market only works if you sell to an accredited investor, and you have to hold on to it for a certain amount of time. And so
that's right.
Secondary markets right now it's gonna be a waning. I don't think that's gonna come in for a couple of years, but I think what we will see is there's gonna be sort of a several services being provided by companies that service the crowdfunding industry, which you see now through services like Fund America, just to plug, Accredify.
Good one, Peter. Good one.
CTO of Accredify.
It's my co-founder.
Yeah, and which is why I know a lot about crowdfunding, and why we're focusing on it. I'm kidding. So there's a lot of services out there right now that are providing these tools, but it's going to be a while. It's a long-term bet. I think Seed Invest is heavily it's there. I mean, they've got I think about 11,000 investors or people on their system, and so they're probably one of the largest portals out there that.
I think one of the interesting things with crowdfunding is going to be to see the tension between the VCs and the crowdfunding platforms. Like, are they competing for deals or not?
Because the thing is, like, these are coming in at early stages. Like, the amount of money you can raise through these rounds are very small. And so really what it does is it provides social proof, and your initial investors, especially when Title III kicks off, are going to be your primary users.
I think Scout has a good model here of being on both sides of that equation with
well, we like to cover our bases.
Seed Invest. No, but it's true though, right?
Yeah.
There is going to be tension when you list your early stage company on a platform that some other large, well-capitalized third-party fund comes in and scoops up a deal and uses that platform as a form of validation.
Yep.
Or alternatively, it could work the other way too, where they're willing to put in X amount of dollars if Y amount of dollars is available from the crowd.
Sure.
And so the validation goes both ways, but it's it's happening.
It's going to be cool.
Continue to
It's going to be exciting. I think really it's huge. It's not there yet.
There'll also be fraud.
Oh, tons of it.
Yeah.
There's actually a few companies.
Not in Miami.
No, Miami is completely fine.
Probably headquartered and based and operated from Miami
So
globally.
actually, that's
literally
a good,
from this chair.
That's a great point.
Right here.
You want
This
to
one,
go
yeah.
with a crowdfunding portal that's based in the U.S., that's regulated under our laws, and has their due diligence. I mean, they don't just list any deal.
They're required to do background checks on entrepreneurs, do anti-money laundering checks on everybody that's involved. There are a lot of strict rules. In fact, that's the very reason Title III still doesn't exist today. The proposed rules were, I think, like 565 pages or something like that, all with going down to extreme details. So it's an extremely complicated process to try that, or the SEC is tasked with of protecting everybody. And there are companies out there like CrowdCheck that are trying to take advantage of being able to do this due diligence for investors, because they understand that the crowd doesn't really have the time or the resources to be able to gather this information.
Yeah.
There's also a whole other topic of conversation here, which is raising too much money, or raising money when you really shouldn't have been able to raise money, that I think crowdfunding is going to introduce. Money doesn't solve the fact that you have a crappy product or that you're just not a very good team. And being able to convince a crowd of people to give you money will only frustrate people and taint the environment of investing in startups, will waste your time and probably make you depressed, hopefully not to a point of suicide for having that burden on your head. But the point is that that's where I think smart money versus dumb money comes in. It becomes a topic of conversation again, because a lot of these crowd investors won't really know how to validate and evaluate whether a startup is worth investing in or not. So there's going to need to be controls for that. I'm not the person to answer that question, but it's something to look out for.
Is backing you up right here. They basically say when Title III or Reg A+, which is the other method, you can only invest up to 10% of your gross income. If you're homeless and you make no money, you can do only up to $2,000. But Like, that's actually a good trick.
Not a
Get a
good
bunch of
example,
homeless
Peter.
people, and just, what is that, money laundering, right? You just give it whatever. I actually just noticed you guys are both wearing the same shoes.
Yeah, I was actually noticing that too. I think they're reverse colors.
Entrepreneur shoe.
Apparently.
I left my blazer in the car though. I'm sorry.
He didn't get the memo.
So, okay.
And one quick note that's kind of a tangent for all this that was mentioned earlier was reporting.
Yes.
And I think it's important to know that, just for a tip for the entrepreneurs out there, at Scout, we find our best entrepreneurs have the most clear and consistent reporting to us monthly. So it's not something that an entrepreneur should see as a burden, but as a tool. So if you're serious about building a successful early stage company, I think clear reporting and metrics are key. And forcing yourself to do that, even though it's a pain every month to send it to your VC, as Brad knows, it really helps our entrepreneurs to get better. So, side note, put it in the file in the back.
I wouldn't even. That's not a side note. I think like early stage companies, when you launch and you're trying to show social proof, metrics, key performing metrics, decide what those are for you and log them and show, and so you can show, if you have these records like cost of user acquisition, lifetime value of a member. Those are things that investors want to see, and a seasoned entrepreneur will do that. And early first-time entrepreneurs don't really understand those metrics, and so what he's saying is like being able to keep track of those metrics and then constantly being able to update them is important.
Yeah, we try to get monthly reporting from our entrepreneurs, and we find the ones that do it consistently, clearly, concisely, the ones we can call up for the information and they can get it back to us within 24 hours. They know they have their system down. Those are the companies we have the least amount of trouble with and tend to be moving on to Series A and crushing it. So we don't think it's a coincidence.
Yeah, it's super important. I mean, both of you have both said it, that you need to be good at reporting. And that's actually, there's another factor to that we didn't really quite touch on is when an investor doesn't invest again, that sends a signal to other investors as to why are you not investing again? And that might force them to not invest as well. And so that could be the difference between keeping your investors updated versus not telling them anything at all. Could be the very difference of whether they want to invest again and potentially you succeed in raising another round. So.
Cool. I think one thing we didn't talk about here is private equity. And where does in terms of large companies in that, like, how does that come into play? Does it even come into play at all? And when?
Yeah, sure. I think traditional private equity does not play in tech. I mean, technically speaking, a venture capital fund is a type of private equity, but the distinction is typically that when you think about a traditional private equity fund, they are investing in mature, stable businesses. They typically look for stable and growing cash flows, typically with a but attached to it, meaning but a bad capital structure or but a changing management team or but something. But they look for those stable, growing companies. I think recently you've seen more traditional private equity firms looking at later stage either growth rounds or even later stage pre-IPO rounds as these private equity funds have grown bigger and bigger. This is an alternative source of deal flow for them, and they're willing to kind of reverse the order. So if traditionally they were looking for stability and growth, now they're maybe looking for growth first and stability in the future, still within the mandates of their funds. And there are plenty of later stage growth companies that would traditionally be funded by VCs that do fit into those mandates. And so there is a bit of a convergence, and that convergence is more pronounced the further along the growth curve you go.
And for a lot of these private equity, and I used to work in finance. The hurdle rate for them is the returns on venture have to be outsized to make the risk worth and the lockup worthwhile. But if you can get in at a later stage, the last round before Twitter goes public, you can double your money in 6 months. And as a venture investor, a 2x return is not great. But if you're an institutional, digital growth fund at a Goldman Sachs or JP Morgan, you'll take that all day long. So, they've been moving into these late stage, just getting in pre-IPO because it makes a lot of sense for them.
I really think in the later stages of a business, the distinction between what is a late stage VC deal and a late stage growth private equity deal, those two things are at this point a distinction without meaning in many ways, and you can see a lot of crossover. The VCs may focus a little bit more on truly technology-enabled businesses, but in this day and age, most growing businesses are technology-enabled in some way, and so that distinction is more and more disappearing. And as you get closer to the land of IPO, I think you see a lot of cross-pollination on deals.
Yeah, and a firm like Goldman Sachs will buy 5% of Twitter, then cut it up and sell it to.
Yeah, that's actually a great point. A lot of private equity funds have varying strategies under the same umbrella. Mm-hmm. So they might have a traditional LBO fund targeting traditional brick and mortar manufacturing businesses, but then they have a portion of the fund or a separate fund dedicated to growth initiatives, and then that fund with dedicated personnel is participating in what you would traditionally think of as a VC deal. And so again, it's all one capital base going after the same thing, which at the end of the day is really two things. They're going after IRR and they're going on after
fees.
Cash on cash, right? I mean, three things: fees
and get their fees.
Yeah, but that's really the truth, and cool. So they're mostly competitive at this point.
Before we get into questions, because we're running late right now, I just want to thank you guys for coming out here and taking your time to talk to our members. So thank you. And before we get to the questions, outside on the table there are 3 stacks of paper. It's what would have been at the knowledge stations, and so it has a quick one-sheeter about the different types of funding, as well as some frequently asked questions and sort of what stages they typically invest in. So if you want to grab that on your way out so we don't have to throw away a bunch of paper, that'd be great. Some announcements. Next Tuesday we do have the city event, which is maybe sold out. Let me make sure. No, we've got 10 more tickets. So they're free tickets. Again, free beer, pizza, all that awesome stuff. City FinTech Meetup, it's on our website. Our next event will be on launching your company and growing it. So we're going to have some growth hackers. We're going to have different marketing and things like that, how to actually, once you launch your company, how do you grow it. So on to questions. Go for it.
In respect to equity crowdfunding, what would be the pros and cons of maybe listing my company on more than one platform at the same time?
Okay.
So the
Pros and cons of listing
that's
your.
actually, I'll stop you right
I have
there.
to
It's
repeat
illegal. You can't do
It's
that.
illegal.
Con, it's illegal.
Okay,
That's a con.
Before you guys answer, let me talk because I have to repeat it for the camera to catch it, so that when we put it online, it makes sense. So yes. Anyways, any other question?
Okay, so that was an easy one, so we'll move on to the second part. And what about priming the pump? If you have someone that is going to put in 100,000, you're looking to raise $500,000.
So can you list your company and have somebody on the side who's going to just initially be the first 100 grand?
You absolutely can do that, and that's a very smart thing to do if you want to try and show that you've got traction off the bat. I mean, there's nothing wrong with doing that, to say, okay, we're going to do an equity crowdfunding round and we want to raise at least this much, to show people that there are other people who have already committed, or just to show that there's traction within the round. That's one of the great things about crowdfunding, is it's fully transparent. You can see where people are along their round. Are they going to raise it? Are you going to be the difference? That's an advantage of crowdfunding.
All right, next question. Okay, we'll go this way. Okay.
Yes, if I'm a new company and just a year old, and I'm looking for investors, what type of information are you guys looking for?
So if you're a new company, what are investors looking for when you're trying to raise capital?
What does a monthly report consist of?
You mean from an existing investor, how do you keep them updated? Is that what you're
No,
asking?
she's saying both, but let's say she's trying to raise some capital. What are the documents she needs to sort of show something to raise capital?
Sure. I mean, there's really 2 different things. For your existing investors, or I guess we'll start with the new investors, you want to have a approximately 10-page presentation. You probably want to also have available a 1 or 2-page summary of your business that you can easily distribute, something that very clearly gets to the point of what your business does, what you've accomplished so far, who's on the team, that type of information, but delivered in a way that people with extremely, extremely short attention spans can grasp, because they're being bombarded with hundreds, if not more, of these per day. And so if you want to stand out, you have to make sure that it's as clear and easily understandable as possible.
It's like pitching to toddlers?
Honestly, yes, in many ways it is. But one of the ways you can kind of end run around that is by going directly through relationships you have, so you make sure that the person you're targeting gets the materials you want and reads them. But you have to find a way to make it clear and easily understood.
So
And I also think something else is key is know who you're pitching. If you're coming to Scout with an idea that you have no beta, you have no users, you have no testing,
And it's in biotech.
And it's in biotech, we wouldn't do that. And so now what you've done is you're in our system as someone who's already kind of wasted our time. So be conscious of who you're pitching to, because we get literally 25 deals a day that we see coming through our website, or referrals, or referral is always the best way. And if you are too early, then you can approach us saying, I know you guys don't invest in me at this stage, but can you give me some feedback? And that's the sort of stuff we're happy to do. We're very pro-entrepreneur, but I think it makes a lot of difference if you go in knowing who you're asking money from, and what they like and what they like to see. If you show us a company that's got a $10 million valuation and it does human resources technology, like none of that is what we do. So be conscious of that. Yes.
I think it's worth noting that no one has mentioned that you need to have a 50-page business plan, because you don't.
you don't.
Yeah,
No.
like maybe you should for yourself, because you need to really think through what this business is going to look like, but no one's going to read your business plan. So if you haven't done it yet,
They maybe do that in college.
don't worry. Yeah.
Well,
but
I think it helps you. It
even
helps
for your
you.
college
And watch out for
professors.
consultants who
Yeah.
say we'll help you write a business
Yeah.
plan.
What hasn't
Yeah.
been mentioned yet is a financial model, though. It is important that you understand sort of what your business model is, how you plan to make money, and also really a test of your competence, because most investors know what numbers you give them, they're bullshit. You're never going to reach them. But what they don't want to see is we're getting 1% of a market that's $1 billion, or a billion people, and we're going to be $1 billion company in 2 years. What they want to see is that you've really thought about the assumptions and your sort of approach to why you think you can reach those numbers year after year.
I would say
some-
that's. Oh, sorry.
No, so I'll just jump in as if I was a panelist. So some of the so I worked at the Launchpad for 5 years, helped a couple thousand companies over that time period launching businesses. So one of the we've helped people raise money. Whatever. What you want to actually have is, like he says, financials. Understanding like your cost per, like let's say, are you a business? It's like B2C.
Not me.
No, so it's B2B. Business
Yeah.
to business. Okay, so understanding your business, understanding sort of like how long it takes to close a client. So what are the average, what's the lifetime value of that client? So having like a financial model that allows you to sort of plug in numbers and say, well, if we put this, into here, this is sort of where we'll be ideally. And so obviously it's just experimental, but understanding your business that well will help you, close more deals, and it'll help you be a better entrepreneur. I'm sorry, go.
I would like to ask how, we have a media platform. We don't have any technology, particularly breakthrough or anything like that. But we got a niche already. When we will be ready to ask for it?
So you have a traditional business, or rather a technology business, no in particular IP, but you have a niche and you want to know when you can raise capital.
Basically, we have, my colleagues call it a blog. I call it more sophisticated, like a media platform. And we talk
Sure.
about technology for Spanish speakers. That's
Sure.
it.
So when would that be appropriate for her to raise capital? Or
Well, I'm not sure off the bat if it sounds like a venture capital type of company. Well, at least for technology investors, we like to have some sort of proprietary technology for Scout. So I think, when you're ready for capital, when you need capital, you just have to find the right investors, and that's kind of what the challenge is will be for you. You kind of know your market, so who in there, in Miami, there's a lot of different media companies. There's a lot of media people, Spanish-speaking media. You could get a group of them together. Who might be
Strategic
an angel.
investment.
Yeah, a strategic investor.
Talk to like Univision, who I don't know what your niche is, but if it's Spanish, if you have a Latin niche and you can partner with a company like Univision, they don't have the resources to do small independent things. You can always do a strategic investment. They'll fund potentially, or they'll promote you, which is just as good as money.
I think it's just worth recognizing, just on top of that, there's sort of a distinction is a lifestyle business versus a venture capital or an equity business. They're two very different things. One doesn't need as much funding or doesn't need any funding at all, but it's still a very sustainable business that brings income to the founders. Whereas, as we sort of mentioned earlier, investors are looking for returns, usually big ones. So they want to see growth capability.
Yeah, we really need, as venture investors, we really need exponential growth, within a 5 to 8 to 10 year window. And that's not to say you can have a tremendous company that builds widgets or provides a service where you slowly grow over, provide yourself an income, support your family for over 20 to 30 years, and then sell it for millions of dollars. I used to work with those people all the time in wealth management, and that's a great outcome. That's a great lifestyle. So there's nothing wrong with that. It's just not the type of companies that we need to look for our investors.
Next question. We've done some here. Let's do this side. Okay.
So we're a custom software development shop in Coral Gables. We get a lot of tech startups that come in to visit with us to look at starting their businesses. And two questions. One common thing that comes up with the tech startups that come to see us, or they ask questions about equity partnerships. And I'd be curious to understand, does that make us an investor, and does that impact their future potential for IPO because we're not accredited? And then part two, what should we suggest to the ones that we filter through? I mean, a lot of them are terrible ideas. Some of them are really good, but they don't have capital. What is your funnel or filter that you use to find those type of great opportunities?
Sure. Well, to the first question, this is something similar that comes up with my partners at Rocker Labs quite often. So I'm going to caveat this by saying I'm not a lawyer, nor am I an accountant, so talk to your lawyer and talk to your accountant. But generally, if you are among the first shareholders and you do something like a services for equity arrangement in that case, you don't have to be accredited. You're basically a founding
family
shareholder,
Yeah.
right? And so you'd be no different than if you were number 2 employee, let's say, right? As to what they ought to do, there's a host of literature about what you ought to do when you have a great idea but no capital. And the short answer is you got to hustle through it somehow, right? You have to find some kernel of validation to convince someone to support you if you can't support it yourself. Ideally you can support it yourself, but there needs to be a something, right? I mentioned this, I think, at the outset. More than an idea but less than a business. You have to figure out how to get to that more than an idea, and there's tons of possible ways to do that, but the long and short of it is it comes down to just hustle.
Yeah, and you're not going to, no company in that first stage is going to get angel money or institutional venture money. It's got to be friends and family, or they got to figure out somehow, drive an Uber at night and save money, do what
Speak on panels.
Yeah, what founders do.
What, we have to
that's
pay
what
you guys?
founders
That's
do.
our secret.
Shoot.
I'll be passing the hat around shortly.
Yeah. Okay, that's better. All right, go for it.
So as you start working in your idea and getting to that business-like model, is there any preference that the investors go for as the company structure?
So are there any types of structures that are more favorable to investors? And the answer is?
So once you are raising venture capital funding, you're likely going to have to convert to a C Corp. It's really the only way to move forward. So whatever you had before S Corp LLC, you're going to end up basically taking a real institutional round. You essentially have to rebuild the company, and you're going to end up mimicking the distribution of shares, but everything needs to be restructured to allow for that type of investor to step in.
The one thing you have to be careful with, though, is when you transfer from a certain type of entity to another type of entity, and if you called it something else, if you're transferring ownership of property or shares, you may be hit with it's a taxable event at the, what is it, 15%?
Capital gains rate?
Capital gains
gains.
tax. You might get hit with a capital gains tax on your own company, so you have to be careful when. And also, like if you have shares in your company, whether they're fully vested or we didn't even talk about vesting, but if they're fully vested or not fully vested, that's going to also potentially affect your liabilities. And so, it depends. If you get like a Delaware C corp, you have to worry about potentially double taxation versus pass through. There's a bunch of issues, but.
Yeah, once again, we're not lawyers, so this
Yeah,
is
not a
obviously
lawyer.
something that you know you can discuss with a lawyer and accountant. But generally, I've seen it's most companies when they're very starting out, just working on the idea, but they need some sort of incorporation. They just go to simple LLC because that's the easiest to switch over. If you start with another type, it's a little bit more complicated. That's generally the simplest way. But once again, you need to talk to a lawyer about it.
So when should you incorporate your company?
Whenever you need to either attract employees or sell shares to investors, you should incorporate. But
Also to protect yourself.
Yeah,
again, to
liability.
protect. So it's a lawyer and accountant question again, because it depends on the type of company. Maybe before you even start operating, you want to have a layer of protection. For taxation, you want to have some structure so you're not paying taxes directly, and you can write off more of your actual company expenses. So
I generally think if you're spending money on this, you should organize it, as a corporation and keep track of, and that's going to be the $200 filing fee on the state. Go to Sunbiz, you can file overnight. You'll get a tax ID, and then then you can go to a bank. You can put a few $100s in a bank account, and then you earmark capital, and that's where you start.
Yeah.
That you use that for the company.
You'd be surprised how fast you can get a tax ID from the government. I mean, you call them, it's immediately.
And that's important too. You want that tax ID because you can go get a bank account with that. And it's extremely important. You want to separate your finances from your personal life and your business life as soon as possible, because as soon as you go down that road, it becomes very hard to sort of separate between the two.
Cool. This lady right here, I'm sorry.
I actually got two questions. Regulation A plus is non-accreditors. How does that affect future funding because of the fact that they're not?
It's regulated.
Okay, question number two then. Since Regulation A plus is a mini IPO, how does that affect future IPOs?
It kind of comes back to what Sonny said earlier, which is when you do an IPO, you have to bring all the shares back into under compliance so that you have everything under one system again. But Regulation A plus is sort of designed so that it becomes an easy transition. And I actually think you have to do something similar along the lines like in mini IPO, that you have to get you have to know where all your shares are. You need to know who is on your cap table before you can even go down that road.
All right, go for it.
We have a tech startup, and we are about to launch our minimum viable product in the next 2 or 3 weeks. But we're struggling with pre-money valuation. We have no idea how to evaluate that.
So how do you value a new company?
This is honestly one of the most common questions I get asked. I think the part of using the convertible notes or a safe note alleviates some of that issue. In many ways, it is just impossible to value an early stage company, and so you want to be more qualitatively fair as opposed to quantitatively precise. And I would just say, reach a deal that makes sense. If someone's putting in money, and you think that the next 18 months to 2 years of this business requires $200,000, that would imply a different valuation than if you look at that same runway and you decide you need $2 million. And so it's much more art than science when you're talking about a new business. And
Are we talking about raising capital or issuing shares to partners?
Yeah, so that's raising capital, because I have two techs that started in the past in my life. I never raised funds before, so they just very cheap to launch it to market. But now, because we want to grow quick, we're thinking of raising capital, and that's what we're thinking. Well, how are we going to value these when we go?
So there's a lot of ways for you to, so valuing a company is, as was stated, is an art, similar to selling anything that is sort of invaluable, so to speak. It really comes down to what a seller is willing to sell and what a buyer is willing to buy for. A helpful guiding post is recent transactions. And these days you can dig that data out of sites like angel.co, Mattermark, and Crunchbase. And you can see, based on how many employees and engineers you have, what kind of product you're building, how long you've been at it, where you are located, Miami versus somewhere else, what other transactions have happened, and that can be a guiding post. But at the end of the day, in an ideal scenario, you'll be getting what's called a term sheet from multiple potential investors, and each of them will have an individual bias or slant to what they think your company's worth. And so you have the number in your head, what you think is fair, and then you have term sheets of what they think is fair, and you either pick a term sheet where there's a match or where it exceeds what you were expecting, or you come to reality that that's what people are willing to pay for your company and that you accept that valuation if you want to, or you keep going organically.
When you look online at other companies, I mean, I think TechCrunch is a bad example. I mean, a lot of those people are serial entrepreneurs, have crazy backgrounds, and or have somebody on their team who just adds that much more value. So it's a good guiding post. It's just, if you see somebody, same exact product, raise $10 million in seed round, there's got to be something to it.
Yeah, and as Stanley pointed out, a lot of quite frankly, it matters where you are. Like, your company, your tech company located in Miami is not as valuable as it would be in Silicon Valley, and VCs aren't going to pay as much, and we just have to get over that. Sorry. Or move, but I mean,
but if you move, you'll be hiring engineers at like 180,000. You're going to burn through your money in 2 days.
And have fun with the taxes out there.
Oh yeah. Well, because there's income tax for the state as well.
No, but why is it?
Why are there different valuations? There's many reasons.
It's just a premium you pay because you're in Silicon Valley. But there are more investors. People pay more.
Yeah.
It's
where all the money's at. So everyone's competing for the same deals.
Deals are bid up constantly.
Also, it's easier to find like senior level talent. So from a company's investment perspective, they may not have the team they need now, or they need to hire people. What's the likelihood that they're going to hire the right people when they need it if I give you this money right now? So we're definitely a growing city. You guys saw, 200 people come to these events every month. So it's definitely a big thing, but we're not there yet in terms of number of companies and density necessary to come up with the similar valuations. But that said, our cost of living, our no income tax for state and things like that, you don't need as much. So, next question.
Yeah, when you look at a company, what is the strongest indicator of success?
Strongest indicator for success in a company?
Really, founders, founding team, really, and that's really where you have to focus in on. And at this stage, it's more art than science, but really a strong founding team, and the product and technology, that all has to be there, but it's really about the team and the culture that they're building. That, at least for us, that's what we.
Cool. We have time for one more question. Go for it. So your question is? So at the end of the day, though, from your perspective, if they can't raise money from crowdfunding or angel investors, you probably also don't want to give them money either.
Yeah.
Right.
So I want to answer the previous question, actually. What's the leading indicator of success? In my opinion, the leading indicator of success, the solid answer to that is sort of ephemeral. It's success itself. And whatever it takes. Somebody will tell you one thing, somebody else will tell you something else that they think indicates success, but the reality is that it can be anything. Something that stands out that says that this person is on a trajectory or is already succeeding, this person, this company, it can be anything. It could be large number of customers, fast growing, founder that's already knocked it out of the park a few times before, great roster of investors, great roster of potential customers. So it's really just a matter of finding out what's the lowest hanging fruit for you to signify success and really going after that.
Cool. Well, we've gone over by half an hour. I'm sorry for wasting your time. Thank you. I mean, not wasting your time. For those of you who've been waiting patiently, I'm sorry for going over the time. That's what I meant. Thank you.